Good morning. Welcome to Trading Hour. Still no meaningful recovery for the markets inside, down over 1% on the benchmark indices. The Nifty struggling below 24,000, and we're in a sea of red across the rest of the global markets too. Mid-caps too under pressure now, down close to about 0.6%. IT, banks, metals, these are the problem pockets for the day. I'm Reema Tendulkar. With me over the next 1 hour is Sonal. Hi, Sonal.
Hey, Reema. And you named the sector and it is in the red, barring pharma today. Yet again, it's the pharma space which is doing well. And that continues to be the trend that we've seen. That index is at the day's high when we are looking at markets falling below that 24,000 mark. The mid-caps continue to suck, though they are relatively outperforming the benchmarks. They're down just 0.6%. Bank Nifty is putting a lot of pressure. We do have the FMCG index, which is under pressure. But financials, metals and the banking index, they continue to be the big drag on the market as well. So we'll keep chatting about this and discussing it with our guests on the show as well. But for now, if you look at some of the stocks which are bucking the trend, BPCL, for instance, is up around 1.5% as we speak. So this oil marketing space today is in the green in an otherwise very weak market. We have Dr. Reddy's, which is the top Nifty gainer today. That index is up around 3%. Cipla is the other one, which is up around 1%. Trend did make a recovery from the lows yesterday, and today as well it continues its trend. So that stock is up around 1%. But other than that, we have losers, the likes of Asian Paints that continues its down move. We have Bajaj Fin. The metal index did come for some profit taking towards the second half of trade yesterday. That continues to be the trend today as well. So JSW Steel is down around 2.5%. But it's also a day of listing. We did see 3 listings yesterday. Today as well, we have Inventurous Knowledge Solutions that made a strong debut on the exchanges. The stock listed at a 43% premium at 1,900. This versus an issue price of 1,329. Winnie is joining us with more on the company, the stock and the outlook going forward. Winnie.
Absolutely. So an interesting day, 43% uptick in terms of the listing premium that we saw coming in for IKS Health. Now, obviously, in this, some of the promoters had gotten out and sold some of the stake in the company. This company is actually an interesting one. It is a technology-based healthcare solution provider, and they mainly cater to clients that are more like physicians and clinics is what they focus on in the US market, and they provide services in terms of technology to such clients. So yes, making their day-to-day jobs easy is what IKS Health focus on. Other than that, when you look at it, there's no listed player in India which is a direct comparison to it. And today a strong listing coming in. So in terms of the FY26 PE that one would look at would be somewhere around the 54-55 times mark for FY26. So that'll be interesting to watch out for at the current price that we're comparing. So yes, that is something to watch out for. Other than that, in terms of CAGR growth, the company has managed to see good growth over the last few years in terms of revenue, 54% growth in terms of CAGR over the last FY22 to FY24. Profits growing at 26% for the same period of time. So good listing coming in, an interesting one to watch out for going forward.
Thank you very much for that. We chatted with the management during the IPO. Listen in to what they had to say about the growth going ahead.
The reason they dropped to 31% last year was because we acquired a company called Acuity Solutions, which has a very large customer base. IKS traditionally had about 35,000 physicians under management. There are 900,000 physicians in America. IKS had 35,000 physicians under management. We acquired Acuity last year that actually has 120,000 physicians under management. So together that's 155,000 physicians, which is 18% of all of America's physicians. That becomes now our captive customer base into which we can cross-sell our entire platform, which forms the growth thesis for the next 10, 15 years. As we cross-sell our platform across these 155,000 physicians, it creates a captive opportunity of up to $28 to $29 billion. We're seeing margins in the range of early to mid-30s as we stabilize. Outsourced TAM is growing at 12%. If you look at our historical growth rates from FY22 to 24, it's, on a standalone basis, we're 27%. So when you look at the outsourced TAM growing at 12%, our historic growth rates, our acquisition of Acuity and the massive customer base in which we can cross-sell, we feel very confident that we will far outpace the outsourced TAM growth rate of 12%.
Okay, all right. That is the word coming in from this new listing. But with that, let's move on now and get into the Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed investment decisions. This week, CNBC-TV18's Nigel D'Souza sat down with Vishal Mehta, CMT and founder Market Scanner, to understand why trading during low liquidity periods is risky. Let's listen in.
Why is trading, in a low liquidity market rather risky, especially in the F&O market?
Indian markets are the most liquid ones. Like Indian options market are considered to be the most traded contracts in the world. We have introduced next 45 stocks in the future segment. But liquidity is always when you are entering.
Yeah.
The problem is when you want to exit in a panic scenario, the liquidity dries up. So the more important part is you trade the liquid counters. And because I've seen in my personal experience, the stocks which were liquid, all of a sudden turn illiquid and you do not get proper exit. And in this scenario, the only thing that can save you in the derivatives market is a hedge position, because you know that this is the maximum loss that I'm going to incur.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, markets continue to sell, so it's a good time to get in a technical check on the markets. Vishal Malkan joins us for just that. Vishal, it's the expiry day. Do you think we'll see some reversal because there's no respite from the lows?
Yeah, I think the way markets are behaving today looks like a kind of a retracement from the previous upswing. We are exactly at like 61% retracement of the previous level. So I think around this 23,900 and 950, there is an important support for Nifty as well as Bank Nifty around 51,500. So this can be an important support, and we should look for some kind of bounce back from here today or tomorrow, which could be a good sign that, okay, the bottom is locked. But specifically, stock specific should not be a problem.
And the stock specific calls would be, Vishal?
Yeah, clearly the winners for today are pharma sector, and that's been outperforming sector since the last few months. And in the last few days also, when the correction started, some of the stocks didn't correct that much. So that shows that outperformance. So first one would be Lupin, which is sustaining about that 2050 level. So I'll go with a buy on that with a stop of 2075 for targets of 2200 and 2250 in the next few trading sessions. And the second one, again from the pharma sector, would be Zydus Life, which is kind of making double bottom at the same level since last few days, forming a reversal pattern on the upside. So I'll go with a buy on that with a stop of 965 for targets of 1010 and 1030.
Okay, all right. Thank you so much, Vishal, for joining in. So that's the technical check on the markets, but it's time to also focus on the commodity space. Manisha Gupta joins us now, and gold is in focus again. Manisha, tell us what's happening here.
Well, it is, and not for prices, but the kind of import data that we have been reacting to for last couple of days. Now, we all do know, and we've been talking about it, that the month of November has seen record import of gold into the country. But the problem is with the kind of quantum that we perhaps are looking at. Well, the Ministry of Commerce has put out a data suggesting that we've seen an import of around 173 tons for the month of November. While Metal Focus, it's an agency which provides data to World Gold Council and collects and delivers data in 9 countries, has come out with a figure of 136 tons. Well, Metal Focus and various other gold guys in India have been telling us that the numbers seem slightly off the mark, especially coming in from the ministry. And that is because perhaps 40 tons, or the difference that is there, has been reported twice, is the reason the ministry data has been on the higher side. Well, that conversation went on all day yesterday. And by the evening, we do understand that the government is now looking, or rather DGCIS is now looking at a detailed examination of the November import data, and that the data reconciliation will be done with the customs numbers, CBIC numbers that is, and we will see a final number or a final calculation perhaps coming into the markets right now. But even with that, we have seen that the gold imports into the country, and for the month of November, even at 136 tons, if you're looking at that, is on the higher side. Since the time we've seen a duty cut come in the month of July, and the prices came off its all-time highs, and of course ahead of the festival and the wedding season, the import into the country have been on the higher side.
Thank you very much for that. Get into a break. On the other side, we've got an important discussion lined up. So Moin Ledda from Khaitan & Co and Sandeep Parekh from FinSec Law Advisors will join in to talk about Sebi's new SME IPO framework. Welcome back. In its latest board meeting, market regulator Sebi has approved a series of key measures which are aimed at protecting investor interest and improving the various aspects of market regulation. Yash is here with the key highlights. Yash.
Well, Rima, a total of 19 items got Sebi's approval in yesterday's board meeting. The three most important out of them, and to start with the most important out of those three as well, was with respect to the regulations that came as far as the SME IPO, the small and medium enterprises IPO side is concerned. Multiple things got approved, things like companies seeking an approval from Sebi should have an operating profit of 1 crore for the preceding 2 years out of 3 last years. OFS portion, that is offer for sale, cannot exceed 20% of the issue size. Promoters looking to repay any of the debt through funds raised via IPO will not get approval. Selling shareholders cannot sell 50%, more than 50% of their holding. Promoter lock-in in excess of the minimum promoter contribution will be released 50% after the first year and the balance 50% after 2 years. Allocation under NII category, that is the HNI category, will be via draw of lot method. And finally, related party transactions or RPT norms will be applicable on SME as well. Merchant bankers, a few restrictions came on that side as well with respect to the businesses that they can do under Sebi's purview. For other businesses which are not permitted, they'll have to register a separate brand, separate entity, get the approval from the respective regulator, and only then they can do those businesses as well. Insider trading regulations also saw some of the approvals coming in. Importantly, 17 new items got added to the definition of unpublished price sensitive information. These 17 new items will now require disclosure from the management going forward as well.
Okay, all right. Yash, thank you so much for telling us and summarizing the big takeaways from the Sebi board outcome yesterday. But to discuss more on this, Sandeep Parekh, Managing Partner and Founder of FinSec Law Advisors, and Moin Ladda, the partner at Khaitan and Company, is joining us now. Gentlemen, good morning. Thank you so much for joining in. Sandeep, let me start with you. Just the first reaction specifically on the SME bit. Do you think this largely addresses the issue that the regulator has, or more was needed and this is slightly softer for the industry than what was expected?
Hi. So I think it's actually, if you look at it from the SME IPO norms, they've tightened it very, very significantly. It's a lot of tough love for people who kind of going in for these alternate listings that we call SME listing. So a lot of restrictions in terms of profitability, what, how you can enter, the kind of lock-ins. The RPT has been kind of tightened a lot because, again, a lot of it must be coming from experience. But it certainly appears like, they're not happy with what has been happening in the SME IPO route, and therefore they're kind of significantly tightening who can come, how much they can raise, how long they get capped up for, and then also bringing in many of the norms of related party which are applicable to main board companies. So I would say it'll make life much, much tougher for, justifiably or not, of course, we can discuss, but it will make life much tougher for people who want to come for an SME IPO.
Sandeep, let's talk about the justification, right? Tough love, as you called it, for SME IPOs. And we've seen some crazy subscriptions for many of the companies that got listed on the SME board last year. According to you, which of the regulations or restrictions are a little excessive, maybe unnecessary or, excessive, according to you?
So, see, there are two ways of looking at it. My perspective is, regulator's job is not to remove foolishness from the market. It's to remove kind of ignorance. So this is, these are very substantive changes. Again, there'll always be two camps, two philosophies which will battle whether to kind of curb these kind of IPOs by substantive restrictions and kind of what you can do, what you can't do, which is what we had before 1988, which is a merit-based system in which people, in fact, pre-1988, companies had to ask the government that they want to raise X amount of capital at Y price. So I think Sebi obviously has been unhappy with the kind of the excess froth which has been. But again, like I said, is this the correct way to do it? I'm not very sure about that, because ultimately, people will have to learn that there is no free money in the world, and SME IPOs. We've had one example where a small workshop with like 8 employees or 12 employees got multiple times subscription for literally 2 shops that he ran. So I mean, we've had a lot of craziness that's bound to go away in any case. But I think restricting is there are 2 ways to do it. One is to improve disclosures, the other is to kind of have substantive restrictions, which is what I think Sebi seems to have chosen route number 2.
Okay. Moin, coming on this, your thoughts on this? Do you think something else that can be added? There were a lot of issues raised by the regulator as well. Do you think all of it and most of it has been addressed?
I think, as Sandeep mentioned, right, one cannot completely comment on whether all the issues have been addressed, but going to why Sebi has done this, there have been some strange, sort of success stories of SME IPOs. There's been a suspicion of, about money being raised and, diverted in some other way, repaid to the promoter, pending loans. All of these seems to have now been attempted to be, dealt with. But, we will only know how this, shapes up, whether this takes away the bullishness, takes away the opportunity from the SMEs, really. But my personal view really is that these seem to be positive steps. We've evolved even in the general main board listing rules. There used to be times when object or end use of IPO proceeds was not very clear. And all of these things coming in, gapping up some of these, related party-related conditions, also having clear requirements not to sort of use the IPO proceeds only to repay loans, or having stricter norms around that, I think is a positive step taken by Sebi, really.
But some of the conditions that have now been approved, for instance, operating profit for 2 out of the 3 years, that's not even there for the main board IPO. Now it's been introduced for the SME IPO, Moin. So comment on that. Do you think any of them could have been avoided? Has Sebi gone a little too far?
I think that condition is something that does make it unattractive and may make it restrictive for many companies who want to do this. However, there are other, other sort of proposals, like the lock-in, for example, restriction on how much can be used for general corporate purposes, restriction on how much of OFS can be really added. Those seem to be sort of logical changes, but I do agree that just having an operating profit for the last 3 years, if I'm not wrong, 2 out of 3 financial years, is something that's market-driven, industry-driven, and that's not something that rules out even companies listing on the main board, as you rightly mentioned.
Okay. Sandeep, then what do you think? There are some restrictions, as of course, we spoke about profits, right? Some of the restrictions that we've seen in the SME IPOs that should and could be applied to main board IPOs as well, because we also have seen a lot of main board IPOs which are not profitable, but they do make substantial listing gains.
No. I'm completely not in that camp at all. I think the problem with SME IPOs has been there's too much froth, and it's been pretty crazy. So I think this is kind of may not be the best way to, but this is the way Sebi is handling it. To restrict main board companies to have profits for 2 out of 3 years is kind of really bad move. And again, goes back to that pre-1988 move of government or some kind of bureaucrat or regulator trying to control the flow of capital. So long as it goes through a book building process, people are coming in with the eyes open. I really don't see that should come into the main board at all. People should be free to invest in loss-making companies, so long as many of these have long gestation periods, and therefore it's good to have those companies raise capital, scale up. We've seen a lot of that money. We're beneficiaries of that, right? Every time you get your 10-minute delivery, it's probably come because of valuation which the kind of capital many of these companies have raised through IPOs. So I think it's a lot of it can be productive. So I don't think many of these restrictions ought to be imposed on the main board.
Out of time, but we had some more questions on even the changes made to the unpublished sensitive information. But for another time, Sandeep Mohan, thank you very much for joining in on CNBC TV 18. Get into a break. On the other side, we'll talk fundamentals. Santosh Singh from Motilal Oswal Asset Management joins in.
Welcome back. You're still tuned into Trading Hour on CNBC TV 18. It's time to talk fundamentals now. Santosh Singh from Motilal Oswal Asset Management is joining us now to discuss the market fundamentals, the top sectoral bets as well. Santosh, good morning. Thank you so much for joining in. Well, we've seen days of recovery in the month of December and then again that fall. What is the trend now that you are witnessing? Do you think we'll continue to see consolidation for some more months, even though Q3 has seen the recovery that we have spoken about? What are some of the sectors that you are focusing on now?
So see, firstly, I don't expect the markets to sort of go up in the near term. One, because the Fed policy, yesterday the policy you have seen, right, that moved towards a slightly sort of hawkish stance. Right, and then the second part is we need a recovery in our own sort of fundamentals, right? The earnings recovery, which is needed now. So we are expecting that something can happen in Q3, but let's see how it turns, Q3 and Q4 turns out. So that's going to be the key trigger if we are talking about the market recovery. Definitely on the sectoral side, we see a lot of opportunity. We still see a lot of growth into the non-lending financials. We still see some sort of good sort of upside in the IT companies, and that's specifically on the mid-cap IT side of it. So we still see some opportunity. We still see capital goods doing well. Manufacturing is doing well. So we still see these areas doing well for in the near term as well.
Santosh, hi, morning. I know in the past we've spoken about insurance and you did hold some life insurance companies too. Now, increasingly, what CNBC is learning from sources is that maybe the regulator is looking to limit the dependence of insurance companies on their parent bank or the bank assurance channel. And stocks have slumped because of these fears. Are you worried about your holding in insurance companies? If someone is a shareholder, what should they do? Should they just ride it out, or it's a manageable risk according to you?
So just to sort of correct that, my holdings are mainly in health insurance companies, not the life insurance companies. And the main reason behind that has been the regulatory sort of I would say too many regulations coming up on the life insurance side of it. That's the reason we are holding very little of life insurance companies for some time now. We like that segment, but till the time the regulations don't settle down, for a shareholder, money making is difficult. Although I believe that most of the regulations which we are talking about is not going to fundamentally affect these companies, but the stock price might not move till the time we see a settling down of regulations. So that's where I think at least it needs a year or two where we don't see too much regulations, we don't see new things coming in, right? For the shareholders to make money.
You did own HDFC Life, right, in the focused fund? So is that holding still there, or you've exited it?
So we have around 1%. We used to own a couple of percent of the fund. So although we have large insurance holdings, but HDFC Life was around a couple of percent there. So and then we exited most of it because of the because of a lot of noise which is happening. So with noise, it's very difficult. The fundamentals of the company are excellent. They are growing despite all the noise. But the problem is if you have too many regulatory noise, how would you make money out of it?
Santosh, in a market like today, the pharma space is the one which is doing really well. It did that yesterday as well. Do you think tide is turning here? There are some triggers which are working for the space. Would you look at it?
So, see, if so there are two parts to it. One is from a allocation point of view, it makes sense to sort of allocate to some part into pharma, some into IT, or incrementally even a little bit into consumer side of it. It makes sense. So because the cyclical part or the capital goods part of the market have seen significant sort of re-rating, and we have not, and if we leave apart the last 5-6 months, we didn't see that happening in most of the segments of pharma as well. So I would think it really makes sense to be part of in some of the stocks. I would still not be significantly overweight on the sector, but yes, it makes sense to be in this sector.
Auto components was one of your big bets. Are you still as bullish, or considering the noise that we're hearing that global growth may slow down, particularly in Europe, and many of the Indian listed auto component players have exposure to Europe, there could be challenges going ahead?
So there are two regions. So our auto component holding is dependent on two things. One is the auto growth, and second is we only hold a couple of companies, right? And then one actually benefits from any global weakening because they are an acquisitive company, and second one which we hold is more of a India-based sort of autocom company, and yes, there has been some share price impact because of this. But my belief is that the global growth, yes, may remain under pressure for some time, and then we are not seeing a lot of revival there. So yes, the global growth may see some sort of for the global guys, it might be some trouble. But if you are saying that the capital goods part of the market might do well, then the CVs in the next year should start seeing recovery. And if that is going to happen, that autocoms, which are dependent on the CV industry, should see a good recovery going forward.
Okay, all right, Santosh, take that point. So that's the market view coming in from Motilal Oswal AMC. Thank you so much for joining in today with your thoughts. Time for a short break now. Siddhartha Sia, Joint Managing Director at Vishnu Chemicals, will join in next to discuss the outlook for second half of FY25. Welcome back. You're still tuned into Trading Hour. Let's focus on Vishnu Chemicals, the outlook for the company and more. Siddhartha, the Joint Managing Director at the company, is joining us now to answer a few questions on what demand is looking like right now. Siddhartha, good morning. Thank you so much for joining in. Well, Q2 did see some impact of some shutdowns. There were freight costs which are higher. Tell us how Q3 has panned out so far. We are towards the end of Q3 as well. Did things look better versus Q2? What about volumes, both in your barium and chromium segments? Did they see a recovery?
Good morning, Sonal. Thank you very much for having me. I can share with you what we are witnessing now is this better visibility over the last few quarters. What we have seen, visibility when I'm talking about in terms of order book visibility, in terms of the raw material cost, visibility in terms of operating levels at the plant, and we are quite positive in this quarter as well as the quarters to come, because we are seeing a lot more visibility both in terms of domestic market as well as the export market, I would say.
But the freight rates had gone up quite a bit, I think 70% in Q2. Is it still, how much higher has it gone, say, in Q3 so far compared to Q2 and compared to a year ago? And is that pressuring your exports?
It did. Over the last 2 quarters, there has been impact on the sea freight. The freights towards the west have increased by 5-fold post Red Sea crisis. But the good news is the freights have corrected quite a bit, not back to the Red Sea levels, but more at a workable levels where we are able to pass on those freight increases. And the kind of feedback what we got from the logistics team is we are not going to see any more freight increases. Rather, they would go down in the quarters to come.
is that freight rates could go down in quarters to come. It would not be as bad as what we saw in quarter two. So Siddhartha, if you can quantify what was the growth in the first half in both your exports and domestic business, and if you'll be able to improve onto that, because exports were under pressure, right, because of the geopolitical issues. Do you think second half growth will be much higher? If yes, by how much will you improve?
Well, I mean, I would say that our domestic market has been relatively resilient. So, with that being said, our volumes have not been impacted. That's already reflecting in the revenue growth over a year-on-year basis. There's a 12% growth in the revenue, the major impact has come because of the sea freight and substantial increase in the raw material cost. Coming back to your question about the volume growth in exports, with the support of the sea freights, adjustments, we definitely going to see a lot more customer wins, because we were the most impacted when it comes to the logistics cost versus our peers, which are in Turkey and US. They were not, or maybe marginally impacted because of that.
So what was the growth? I'm just asking both volume and pricing growth in the first half in both exports and domestic markets, or was it a degrowth? Will you be able to reverse it in second half? Is it a fair assumption?
Well, I mean, to look at it, there's a significant volume growth in our barium business, and we are, as we move towards the quarter four, we are even more positive. Within this year, we're going to see almost 20-25% of volume growth in the barium business, and revenue growth over 50% over the last year. And this is going to continue in the years to come. In terms of our chrome business, we are expecting a volume growth of close to 8% and a value growth of close to 10% in the FY26.
Okay. You had made two acquisitions, one in the chrome space itself, the other one was in the pharmaceutical company. Tell us, by when will that get commercialized? When will it start contributing to your revenues? Did you have to take up some debt or fundraise for this?
So we have signed a definitive agreement to acquire a coal mine in South Africa. This decision, there's quite a bit of rationality behind it. This is something which was on the horizon for over 15 years now, and we are glad that finally it's happening. And we'll be on ground mining and operating the processing plant in the next 6 to 9 months from now. With this acquisition, we have the raw material covered for the next 30 years. And what's also going to support this is, when it comes to the processing of this mineral into the chemicals, is also going to improve our yields as well as productivity at the plant level. And with respect to Jainshri Pharma, again, I'd like to correct the nomenclature. The idea for us is to produce an import replacement product, which is strontium derivatives, which perfectly fits into our portfolio of inorganic chemistry. And this, we are expecting it to start operating by Q2 FY26.
Okay, Q2 FY26 is when you expect the pharma bit to start contributing as well. On the barium side as well, you have added PBS capacity. So what was the capacity utilization there, and how much did it aid to overall growth? What is the outlook on that one? Because that is something that the street wants some numbers on as well.
Indeed, it's quite exciting in general. Within 1 year of operations, we are operating currently at 70% levels. And we're expecting it to go up to 90% during FY26. There is a volume growth, and also there is a value growth, given that it's a complete import replacement, and we have got approvals from all the major paint companies in India and outside India.
Okay, all right. Siddharth, thank you so much for joining in. A lot more questions, but we are out of time, so we'll take it up some other time. We'll speak to you after your Q3 results for more details on the outlook as well. With that, it's time for a break. When we come back, we'll get you more on the markets on the other side. Stay tuned for that.
Welcome back. Still down nearly 1%. There's been no recovery in the last 1 hour. In fact, there was a little bit of a recovery that we had in the morning itself when the Nifty tried to get to 24,000. But we've not managed to build on that. We've been hovering between 23,900 to 24,000 since morning. Swiggy, though, is holding up smartly. JP Morgan has initiated coverage. Their target price is 730, and this is the highest target price so far on Swiggy, by the sell side community. This month itself, Swiggy has seen a rally of close to about 25%. Lupin's also been a big mover. It rallied yesterday and it's moved up a little bit more today. So that's a stock which deserves mention. Outside of that, on the way down, you've got cuts in Zaggle Prepaid as they look to raise some money. On DOMS, where Fila was going to do a block deal and sell about 4.5% stake, continues to remain under pressure. On Brainbees Solution, that's First Cry, there was an initiating coverage. There was a bullish note, but that's not done too much to help the stock. It's still down close to about 5%. Ipca Laboratories, MTAR Tech, Motilal Oswal has initiated coverage today, so that's pushed the stock higher. It's a wrap on trading hour from the entire team. Thank you for watching.